Good afternoon. Welcome to ICG Enterprise Trust's Q3 trading update for the 3 months to 31st of October 2024. I'm joined today by Oliver Gardy and Colin Walsh, who will discuss our investment performance and activity in more detail over the course of this presentation. The slides for the presentation, along with the accompanying results announcement, are available on our website. We will have time for Q&A at the end of the presentation, so if you would like to submit a question, please do so through the online portal at any point in the Q&A box on your screens. We will then aim to answer those questions at the end of the presentation. With that, Oliver, over to you.
Thanks, Martin, and good afternoon, everyone. We're happy to report another strong quarter. It is another quarter where our clear investment strategy has performed well. We focus, as you know, on mature cash-generative companies with defensive growth characteristics. And also what we're seeing in general, we're observing that the PE market is becoming more dynamic than the previous 2 years. Maybe digging in some of the data, our NAV per share total return rose by 3% over the 3 months to the 31st of October 2024. And our portfolio grew on a local currency basis by 3.1% in Q3. Which is our second consecutive quarter of being at or above 3%. We're also continuing our efforts to develop our medium-term target portfolio composition more towards secondary and direct investments, which Colin will speak more about it later. And then in regards to capital allocation, we feel we've been one of the leaders in our sector and had, we believe, a very thoughtful approach to capital allocation. Our dividend per share has risen 9% on an annualized basis over the last 5 years. And as you know, we've been also early and very active in our buyback efforts. Since October 2022, our buyback programs have returned about £50 million to shareholders. The buyback program added 2.3% to NAV per shares, which is equivalent to about 6.1% of opening shares, which, excluding tender offers, is the most in our peer group, and something we're quite proud of. Continuing this shareholder-focused approach to distributions, the board has also renewed our efforts and our opportunistic buyback program for fiscal year 26 of up to another £25 million. Moving on to the next slide. Many of you have seen the slide before, but we think it is worthwhile just having a quick summary of it because it is very crucial to our investment strategy. Our goal is to achieve for our investors long-term compounding growth, but at the same time reducing risk. As you know, private equity has its is a higher risk asset management class, but it has been over long term the best performing asset class. And so what we do and all what we're focusing on is very much to provide our investors these long-term compounding growth by taking out risk. So when you look at the first 4 columns, those are the kind of our strategy. How we reduce risk. So for example, we only focus on buyouts. Because buyouts have much lower loss ratios and are much more predictable in terms of long-term returns than venture capital, which can have loss ratios up to 60 to 70%. We focus only on developed markets, US and Europe. We do not like to have exposure to the emerging markets, as typically the liquidity and the roads to exit and the path to exit are much more limited. And furthermore, we have over the years shifted much more and pivoted more towards the US, which is now about 44% of the portfolio. And then we focus on middle market to large cap private equity. Why? Because those are typically the funds which have the most experience and are large enough to deploy and attract absolutely top tier investment professionals. And if you look at the last 2 columns, you see this is how we actually really try to achieve growth and drive returns. One is by investing in the top tier funds. Since we are one of the oldest, certainly listed private equity companies, We have the DNA and the access to the top tier buyout fund managers, and this is something we're constantly fostering. And so getting access to the top tier fund managers is fundamental to our investment strategy. And lastly is picking defensive growth companies. And that's how and that's why our dedicated investment team really helps. We're one of the very few investment trusts who have in private equity who have a dedicated investment team who can go and pick and select the best ideas coming from our investment managers. And with that, I'll hand over to Colin to talk about in more detail about the portfolio.
Thanks, Oliver, and good afternoon, everyone. So straight into the numbers. In Q3, that's the 3 months to the 31st of October 2024, our portfolio grew on a local currency basis by a little over 3%, the 3.1%. That translates into a NAV per share total return over the period of 3%. We closed the period with a NAV per share of £19.97. Translating that into returns to shareholders, our share price total return over the 3 months was down, reflective of a volatile start to Q3 and more generally in global markets. But over the last 12 months, our share price total return was a little over 16%. Combining dividends and buybacks over the last 12 months, we've returned £53 million of cash to shareholders. We'll talk more about our capital allocation policy a little later. Turning to portfolio activity, it was a relatively quiet period. We made one new fund commitment of £7 million, around $10 million, to a US-based manager, Valeas Capital Partners. That's a US mid-market manager where the key executives spun out of both Hellman & Friedman and Golden Gate Capital. Really interesting investment in a seeded portfolio where we were able to identify significant embedded value. The portfolio cash flow over the quarter was broadly neutral. We had investments of £35 million and proceeds of £34 million. We saw 12 full exits in the quarter. That's the third consecutive month of an incrementally higher number of exits. And we're optimistic that this trend will continue as we go further into 2025. Those 12 full exits in Q3 were completed at a weighted average uplift to carrying value of 18%. So moving on to the next slide. This slide builds on the numbers I've just taken you through and splits out by investment type. The portfolio growth, as you can see, was spread across our three main investment types, being primary, direct, and secondary, with the discretionary part of the portfolio, so that's secondaries and directs, marginally outperforming. Our closing portfolio value stands at just over £1.4 billion, and a little over 30% of that is in ICG managed investments. Now, as many of you know, every quarter we like to bring our numbers to life with a case study. And today we wanted to spend a little bit of time on a co-investment we executed in the quarter. And this is a Swiss company called BSI Software, which provides software to help manage relationships. And its clients are large customer-facing companies. Now, as we've noted many times, the bar for co-investments at the moment has been relatively high, certainly over the last couple of years. And as we've been trying to be selective and to balance the various considerations around the investment program, how it interfaces with our balance sheet and also with our share buyback programs. What attracted us to BSI Software in particular was its long track record of developing and operating these customer relationship management platforms, a very strong market position in its core geographies, and it has a unique product offering which has an inherent stickiness. It's got very high levels of customer retention. So it's a very good exemplar of what we look for with our defensive growth focus. And alongside the diligence that we conduct within our own investment team, our own dedicated investment team, this is another example of how being part of the ICG platform is very beneficial to us, and we think a really strong competitive advantage. We were able to gain proprietary insights from our colleagues in various different teams across the ICG platform that informed our diligence. It gave us enhanced confidence in BSI's competitive positioning and also the quality of their tech platform, which is clearly especially important for a business of this nature. Zooming back out, We actively manage our portfolio across investment stage, strategy, and geography. Combined, and that is, we have a rigorous portfolio monitoring process so we can identify some of the trends in our portfolio. And by stage, to reiterate, we invest entirely, that's 100%, into buyouts, with no exposure to venture capital or growth equity, where we see a very different risk-adjusted return proposition. By geography, we target a broadly 50-50 exposure across North America and Europe. And by investment strategy, and I think Oliver mentioned this earlier, we've evolved our targets very slightly. It's very much an evolution. So we're going to target 40 to 50% primaries, 25 to 30% secondaries, and 30 to 35% co-investments. That's a very minor tweak to the previous allocations, which were 50% primaries, 25% secondaries, and 25% directs or co-investments. This move to more discretionary investments over the medium to long term, and with having slightly less primaries, we think will be beneficial to shareholder returns. Each of these routes brings something specific to building a portfolio that delivers on our investment strategy. In particular, the primary program allows us to access a deep pool of top-tier managers. Secondaries reduce risk while enhancing our liquidity profile, and direct or co-investments allow us to increase our exposure to the companies that our top-tier managers have identified, which we particularly like. And combined, when we add all of this up, we believe we are very well positioned with this approach to continue to deliver strong risk-adjusted returns. And with that, I'm going to hand back to Oliver for some concluding slides, focusing in particular on the shareholder experience.
Thanks, Colm. As I alluded at the start of the presentation, we believe we have a thoughtful and shareholder-focused capital allocation policy. I know this is a busy slide, but let's walk through the numbers quickly. Firstly, since 2017, we have had a progressive dividend policy. And for Q3 fiscal year 25, we're proposing a dividend of 8.5p per share. And for the fiscal year, and the board reiterates its intention for fiscal year 2025 to pay total dividends of at least 35p per share. This will be a 6% increase on fiscal year 24's total dividends of 33p, and our dividend has increased at an annualized rate of 9% over the last 5 years. And secondly, we have a long-term share buyback program, which was introduced in October 2022. And since its launch, we have returned 32 million pounds to shareholders through this program across 176 separate trading days. So we've been very active. And then thirdly, we announced last year the launch of an opportunistic share buyback program of up to 25 million pounds for fiscal year 2025. And approximately about 18 million pounds has been executed so far. The board announces today that it's renewing this program for another up to 25 million pounds for the next fiscal year 26. Now, if you combine these buyback programs, this means we have bought back 6.1% of our opening share count, which is the highest of our peer group if you exclude one-off tender offers. And it demonstrates our focus on returning cash to shareholders while maintaining our through-cycle investment program. And as I mentioned before, this has added 2.3% to NAV per share. On average, we've been buying back shares at when the shares were about 35 in the mid to high 30s discount. In conclusion, in summary, our clear investment strategy and our progressive dividend policy and our share buy program are designed to deliver long-term outperformance for our shareholders. And I think this quarter is another good example of the program and the investment strategy working. But we're also additionally, we're cautiously optimistic that the private equity market continues to improve in terms of deal activity and realizations. Our efforts to increase our US exposure over the past years has been in particular helpful capturing the growth in the US private equity market. And as you can see on the slide, over the last 5 years, we've delivered 16% portfolio return and a 14% NAV per share on an annualized basis. We believe we have a long track record for delivering to our shareholders, and we remain excited as we begin 2025 that our actively managed portfolio is positioned well to benefit from an environment where we're already seeing transaction activity to increase.